Welcome, everybody. This is the Thursday evening Viper trading webinar. If you're here to learn about trading the futures markets using the Viper tools, you are absolutely in the right place. Tonight's topic is how to manage losing trades. It's a topic that most people don't like to discuss. Nobody wants to talk about losing trades. It's kind of like, what's a good analogy for that? It's like fishermen and gamblers. They never have a bad session, right? Always had that big one that got away. I've been familiar with a lot of folks who like to go to Reno out here, South Shore Tahoe, gambling, slot machines. Maybe some of you like to gamble. It's fun to do. So you get some free entertainment and food and cocktails and what have you. It's fun to do. Vegas. But they always talk about the winners. Everybody's always talking about what? The big one. I remember that time I went to Vegas and I hit that one thing on that machine and I made 20 grand. But, nobody ever wants to talk about the 15 other times that we're losing trips. I mean, that's okay. That's just kind of the nature of the beast. So anyway, let's without further ado, let's go ahead and get started with our disclaimer. All communications from Viper Trading Systems are for educational purposes only. Futures trading does involve risk, and there is a risk of loss. Nothing contained in this webinar or other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everybody in here does know that you do trade at your own sole discretion. All right, let's get over to a crude chart. It is. We're getting some comments from the team coming in here. If you're just coming in, don't worry. We're just starting. You haven't missed anything yet. Let's get over to screen one and look at some crude. TP says this is a great topic and it's one that we should talk more about. Yes, it absolutely is. Now, before we get into talking about losing trades, what is the best way to avoid a losing trade? Let's start with that. All right, let's kick this thing off right. Okay, excuse me. Here I have a text box, and I need to type something into it. Don't trade at all. No, that's not what we're looking for there. That's not what we're looking for. I mean, obviously, you can avoid doing anything. You don't have any consequences. That means you don't make any money. You don't lose any money. You have to take risk. So that's a given. We're going to trade. But so the question on the table is this, and this is what I want to talk about before we get started, is how do you avoid losing trades? Okay, now if I was going to type something in here into this blank, what should it be? How do you avoid them altogether? And the answer is not don't take the trade. we're gonna like I said, we're gonna take trades. It's just a fact of trading. You're going to get into trades, and some are going to be winners and some are going to be losers. We don't like to talk a lot about the losers, but we're going to talk about them extensively tonight. Can you screen, Jim? Oh, do you see the screen? Everybody see me moving the text box around a crude oil chart? Testing the video part. Everybody see the screen? The screen is fine. Yes? Moving text box up and down. Okay. All right. Well, if anybody's having audio or visual video problems, one easy solution is just go ahead and log out and come right back in. That's usually the way to deal with it. Now, I'm gonna answer this in two different ways, and I'm not being evasive, but I really think it's important that we talk about this in the context of a couple of different approaches here. So the first thing I would submit to you is don't get into losing trades in the first place. Now that seems kind of obvious, Captain Obvious, right? Don't get into losing trades in the first place. Oops, first place. Now, when we say don't get into losing trades in the first place, on the surface that sounds PW said wait for great entries, don't move your stops and get into a hope trade from Dennis. Always trade in the direction of the trend. That's good, Jim. Don't take losing trades. Okay, good. Now, I would characterize losing trades in two different, distinctly separate categories. And the first one is trades that are, I'm going to just put this, it's characterized in two different ways. And this is a good way to sort of think about this. Losing trades that are avoidable. Okay, we'll talk about that in a second. And then you have losing trades that are unavoidable. Unavoidable. So what's the difference between that, what we're saying here? What is the difference between what we are saying here? What is an avoidable losing trade and what is an avoidable? Well, let's look at some. There's quite a few right here on the crude chart right now. Let's talk about them. And I would define it at a high level as avoidable are trades that you probably shouldn't have taken in the first place. They weren't, for some reason, set up legitimately. They weren't in the right spot. You got in too early. You waited. You got in too late. You stopped out because it reversed. So I would lump those, and we're going to look at quite a few of those tonight. Okay, these are trades that were avoidable. You got into a losing trade that, all due respect, maybe you shouldn't have probably taken. Right? That's one category. The second category is you got into a legitimate trade that should have worked out, and for some reason it doesn't. Okay, that would be the unavoidable. You saw a trade, you took the great trade, it met all the criteria of taking the trade, and for some reason it just doesn't pan out, and you got to figure out a way to get out of it. Yeah. So that's kind of how I see those two separating themselves. Let's look at some examples before we look at the losers of some good trades that did work out. And then let's contrast those on the screens with ones that didn't. Let's start with mid-band trades on crude. Okay? For those of you that are brand new, I see a lot of new faces in here. I'll just take 2 seconds literally to explain this because we have entire webinars that explain use of our indicators, what they mean, how to interpret them, all that sort of stuff. Basically, the indicators are as follows. We have a data feed from our broker, NinjaTrader. We trade 4 range charts. This is the crude oil futures. We are on the July contract. When a market is in a protracted downtrending type move, generally you're going to see the background is going to be red. Here's a good example of a long protracted sell-off in crude that we had this morning, right? We'll talk about how to trade those, definitely, downtrends like on crude. And then you have markets that go sideways. Here's a good example of a sideways market right here on crude from basically about 7:38 until about 9:30. So here is a good example of a sideways market in the fact that it's really kind of really not going up and it's not going down, and the mid band is flat and all the bands are flat and going sideways. We have predictors on here, which is the short-term support and resistance levels. The power meters are the trends up and down, 4 different directions. Most of you know about the alerts. You can turn on mid-band alerts, deep retracement alerts, minimum criteria alerts. I'm not going to deal with those tonight. That's a topic for a separate webinar. They're very useful, though, and a great tool. When a market is going sideways like this, one of the characteristics, of course, in here is the fact that the background looks like a striped shirt kind of appearance. See how in here you have green, red, intermediate color, green, red, intermediate color, like a striped shirt. Plus the flat mid-band, you are range bound. So that's the lack of a trend, right? Now, mid-band trades, let's look at something that just happened recently on crude as early as less than a half an hour ago. One of the main trades that we like to take, so let's go back here to about 10:30 this morning, we go into a long protracted uptrend. So crude oil is retracing to the upside, right? I'm starting, let's talk about crude from over here. And we'll start with the very basic analysis of the chart. So when markets start to trend, they give the appearance of a solid background, in this case green. The first part of the trend move, in case of an uptrend, of course, would be a thrust in an upward direction, which of course you get right here. Now, where a lot of confusion comes in around this is the discussion around what exactly a mid-band trade is. What is a mid-band trade? Well, it's pretty much defined as follows. When a market has a thrust up to a fresh swing level and it pulls back into the bands above and below the mid-band and or directly sitting on the mid-band itself, the thick line in the middle of the 8 bands, this is said to be a mid-band trade. Let's look at some examples. Here is an example at right around 11 a.m. Pacific. I'm here in California, so everything's Pacific time. You can see these bars dip down to a level in the band above the thick mid-band here, the middle band, and bounced. Okay. This sort of barely meets it. Here you kind of wicked in it a little bit. This is kind of the in between, like a minimum criteria and a mid-band, in the fact that you only got part of one bar in there. That's a retracement long. Here's another example of one right here. And the reason I'm engulfing these with boxes is because we teach this object trader tool, which uses rectangles and boxes as objects to engulf candles, and you can enable it long or short. And so when the market you're trading at the bar closes outside of those boxes, in the case of the uptrend with long enabled only, you'd be filled long on the close of that bar right there as an example. Long. Here's another one right here, filled long on the close of that bar right there. Now, are there other ways to get in? Could you put limit orders in here? Yes, of course. Can you hit a market order if you want to get in and you don't draw a box? Of course you can. There's all kinds of different ways to get in. We show region boxes simply for consistency's sake. If you can learn how to use the object trader tool, it's extremely helpful in getting in and out of trades. Now here's the case where we have a deep retracement, where the bars go beyond, in the case of the uptrend, it goes below the midband and below the band immediately under the midband, dipping down into here. You can hear this referred to in the live room as a deep retracement. We used to call it deep probes, or a phantom type trade, where the market can come a little deeper. The trend has not changed, even though the bars are red. You're still looking for long trades, and so this is an entry long here with the close above the box right there. You get a little ABC pattern, A, B, C, and on the B retracement, you get a couple of bars sitting here. Was that another entry long? Of course it was. Now, here we are right now on the live data for crude. So I just showed you arguably 1, 2, 3, 4, deep retracement, 5 trades, and here's the 6th one over here. Let's look at this. And then we're going to start to discuss how trades work out and how they don't. Yes, PW, I'm going to circle back to that. I wanted to first show all the trades, and then I'll circle back and discuss which ones were winners and losers. Here's another example where crude came down and sat literally with 2 bars perfectly on the midband. That would be sort of a textbook midband long trade there, filled long on the close of this bar right here. So that's another example of a winner right here, because it came up, double top, pulled back, holding line 6. The thin green line is called line 6. We use that both for trail stops and occasionally for entries. Line 2 is down here. That's the thin red line at the top of band 2. So you have you have 1, 2, 3, 4 bands below the midband, right? And the thin red line on the top of band 2 is line 2. And of course we have 1, 2, 3, 4 bands above the midband, and the top of band 6 is called line 6. And you'll see, if you've been in the live room, we use those a lot for trail stops, getting, when we have runners. Now let's talk about which of these examples worked out and which ones didn't. Stand by, Jim. I'm going to ask everybody, just if I can, all due respect, just for a few minutes. I really want to get through a little bit of material here. Just give me another few minutes, and then I want to circle back and take questions, okay? Because I think it's going to be easiest to grasp this material if we all look at it together in the same way. So I want to cover what kind of worked out and what didn't, and why, and how we manage it, and then we'll take some questions. Obviously, you can see here that this long trade on that occurred approximately at 10:57 a.m. Pacific with this box right here did turn out to be a profitable trade. So you were filled long here, popped up, didn't quite get the top. Now let me explain this before we continue. And this is a universal thing that I'm only going to cover really once. Most of you already know what it is. It's the concept of trading 2 contracts on your entry minimum. And the reason for that is as follows. What we like to do when we get into a trade is when a market has gone generally between 6 and 10 ticks, 6, 8, 10 ticks, you take off what's called the scalp trade. So I'm just going to cover this once, and let's do it all together, and then we will assume that all of these other trades are very similar. In the case of the long entry, we will get long. Short would be the same, only in reverse. 2 contracts. And this is true irrespective of what instrument you trade. So this is true on ES and gold, Russell, currency futures. So this is just our general approach to getting into trade entries. So we like to get at least long, in this case the uptrend long, 2 contracts. And one of the first things we do is we look to take profits on what we call the scalp, which is the first contract. Scalp's an old term from the old days when you would get into markets very quickly. That was called scalping back in the old scalping teeny days. Anybody remember that? Scalping teenies? Anybody remember? I'm going way back. I'm going back probably 15, 20 years. How many of you remember when stocks were priced in 16ths? Now it's pennies, of course. Everything's changed and everything's electronic. But anybody remember scalping teenies? Anybody? This is going way back to the old electronic days where this was kind of new and everything with the stocks were priced in 16ths of a dollar. It was called a teeny, and you get in and out get in and out, get in and out, scalp teenies, get a couple teenies here, a couple teenies there, very tight stops. No, that's all before your time. Yeah, I'll bet it is. Those days are gone. Anyway, but what I'm trying to say here is that a scalp just simply means uh, look to take scalp profit. Let's make this a little easier. Scalp simply means that you capitalize on the short-term burst of volatility in your direction. And depending on the instrument, like ES, you might want to take it as early as 4 ticks. I've seen people scalping 2, 3, 4 ticks on ES, so I would say 4 ticks is a minimum. And you could go up to 10 ticks on something like crude, or even 8 to 10 ticks. And then you move your initial stop on the second contract, second lot, if you will. And we don't say break even. You want to come within a couple of ticks, say 2 ticks within the entry. Behind, under or behind the entry. Okay. And then number 3 is you begin, once the market continues in your favor, long or short, you engage the trail stop on the runner. Now, you can trade more than one contract, especially now that we have those micro contracts, which are 1/10 of the normal. So, for instance, on crude, you have 10 ticks per point. 1 point is $100. A tick is $10. We have micro contracts. You can trade those through your broker, Ninja, through One-Up Trader, etc. And they're 1/10, so it's only $1 for a tick of movement, and the commission is correspondingly 1/10. So, say you had a $3 or $4 commission on, your instrument, it's as low as like 30 cents on that. So it's a good way to learn, by the way. They're brand new. They've only been out for a couple of weeks, micro contracts. If you're interested in them, talk to your broker, get set up on them, and you can experiment with them. You can put 2 micros on. That's $2 a tick on crude. You get stopped for 10 tick, it's $20. It's a low-cost way to learn. Now let's circle back to this entry over here. Let's look at a couple of these entries and start to really discuss what we're doing here. Okay, let's suppose hypothetically you were filled long on the close of this bar at 57.77. The market got up here to 89, almost 90, say 90. So what is 77 to 80 to 90? 13 ticks. So in the case of crude, if you had a 10-tick scalp target on, was it hit? Did you get your scalp target off? Yes, you did at 87, right? Right here, 87, you got your scalp off, right? And then you come and you take your initial stop to, say right at break even or 2 ticks behind break even. If you engaged the trail earlier, you could have used, so your initial stop moves from, say, 10 or 12 ticks behind your entry initially up close to where you got in, right? So your initial stop was down here and now it's up here. If you like to use stealth in line 6 in lieu of the 2 tick behind your break-even entry, quite possibly you stopped out here. So you got a scalpy off at 10, and then your second lot turned out to be maybe 4 ticks, something like that, 3, 4 ticks. So it was a profitable trade. You didn't make a whole lot, but it made money, yes? Okay, let's look at trade number 2. Filled almost about the same area here at 80. 10 tick scalp would put you at 90. That's right here. Scalpy comes off. 90 was right, I don't know, about here somewhere. Scalpy comes off. And depending on how you engaged your trail, you either got stopped out here with a double top. You got out of that trade somewhere, maybe with 2, 9 ticks and a 10 tick, so almost 20 ticks on trade 2. That doesn't sound like a lot, but it's $190 less commission, right, on a full contract. Let's move on. How about trade number 3? How did that one work out? Well, let's see. You were filled on, let's say hypothetically you didn't draw the box until these two bars formed here. So let's consolidate the box right here, and now you're filled long on the close of this bar right here. All right, so let's do this. Let's call your fill on this one at 57.85. So with a 10 tick stop or a 12 tick stop, your initial stop is all the way down here at 70, 75. What is that? Yeah, 10 ticks below, so 85 would be 75 right here, and quite possibly could be even lower at 12 ticks, which would be 73. Now, did you get the 10 tick scalp on this trade right here? Well, let's see, you got filled at 85, 86. It got all the way here to 91, which you're lucky if you got 3 or 4 ticks. Here, 10 ticks on your scalp, so your target was actually sitting up here at 95, 96. So your scalp target at 10 ticks was up here. So did you make your scalp on trade number 3? What do you think? Well, let's take a look at it. Let's blow this up in great detail so we can all get on the same page. Here you drew your box. Close outside, you're filled. You get 1 bar in your favor, 2 bars in your favor, and let's contrast the look of this trade, and I'm going to circle all 3, and this is going to help you. This is where the helping part is going to come in, okay? Ready? I'm going to do it like this. Here's how I'm going to do it. What is different between what happens here on this trade and what happened over here on this trade? Let's call it trade number 2, long, mid-band bounce, and trade number 1 to the left. Let's call that trade 1 right here. Let's call this trade 2 and this trade 3. What is different about trade 3? How would you know, what would your clue have been on trade 3 that things were not looking so good? That trade was struggling and having problems? What would have been some clues that would have perked up your spidey trading sense to say, oh, hold on, oh, what is going on here? Will Robinson, we have a problem. What's going on there? What's the red flags? How would you immediately start to know that this trade wasn't working out? How would you know that? Like almost right away. Well, let's talk about it for a second. You got a reversal candle. You got a red stealth come in there. The bars start flipping the other way on you. Good, good. Those are all things. Let me tell you another real way. When you start to watch the P&L on your trade, let's talk about, say, over here. So you're filled. You're just filled. Here you're up like 4 ticks. So on 1 lot, 2 lot, you're up. Here, let's just pretend we have 1 lot on, just for the sake of discussion. Here you're up $40, right? Here you're up $50, $60. You didn't feel any heat. Trade one. Heat, for those of you that are somewhat newer, heat means you're experiencing loss on the trade. And I'll describe that in a second, okay? And then you're up 60, you're up 80, you see this target coming up, and then babango, right here, $100, boom, you're off. You can have a little sigh of relief. Whatever you do, you drag your stop up to here, you take your stop up to here, wherever you decide to tighten up your stop to, and you get out. Okay, that's trade 1. Trade number 2, very similar situation. You're filled long here at 80. Immediately, You feel you're up 10, you're up 20, you're up 40, you're up 60, you're up 80, you're up 90, you're up 100. You hit your scalpy target right there. You're out. You made $100. You feel good about it. Yes. Starts to continue to move in your favor. You're up 110, 120 on that second lot, pulls back, you get out. Now let's talk about the experience on trade 3. How is that different? Okay, now this one you're filled at 85-ish, yes? And you feel similar, and it's natural to have endorphins in this sort of, euphoric feeling when a trade moves in your favor. We all feel it. You feel good. You had a good trade entry, and you feel that the market's moving in your favor, and you're feeling all good about things especially when they start working out and making you money, like these two over here. Now, in this case here, of course, what you feel is you're up 10, you're up 20, you're up 40, you're up maybe 50, maybe 50, 60, maybe 70, maybe 60-ish. And then you notice that on this reversal candle right here, in the case of these candles here, you can see that they all continue to close up in your favor. Yes? They all continue to close up in your favor. Yes? Do these candles continue to close up in your favor and continue on up to get you to this scalp target in trade number 3? No. Your P&L, for that matter, starts to reverse. Here you were up maybe 40, $50, plus or minus, depending on your actual fill, right? And now it's starting to reverse. Now you're only up 30. Now you're only up 40. Now you're only up 10. Now you're up 20. Uh-oh, now I'm upside down. With this bar right here, now you're upside down. Bars continuing to close in the reverse direction of your trade, which is long and up. Now, at this point here, what are your options on this candle right here? What should you do if you find that you are faced with this condition? And it doesn't have to be crude. It can be anything. This happens on all kinds of instruments. If you traded YM or NASDAQ or the Russell, we all get into losing trades once in a while, and I'm describing the feeling and how to deal with it. Do you have to wait to take your initial stop on a 2-lot or a 1-lot? Do you drag it up here? Is that what you should do? What's some other options that you have? Your initial stop's sitting down here somewhere. Obviously, you don't want to take a full hit, especially if you got 2 lots on a full contract. What can you do when a trade starts to reverse against you? What is the quickest way to get out when you see this condition occur on your trade entry right here? And that's the whole thing we say in the room, right? You hear this in the live room all the time. Keep a stop. Don't feel any heat. That's what we're referring to. That's what that means. That means that you should immediately take your stop up and let it get filled. That's option 1. Well, actually, I'm going to call that option 2. Let's discuss the ways to get out. There you go, PW. Okay, good. I see the Byron, Bob, Mario, Dennis, Michael, everybody typing some good responses in here. The most quickest and effective way to deal with experience a losing trade once it reverses in your face after entry is to simply, option number 1, hit the close button. You don't have to panic, get all panicky about it. You don't have to feel your palms sweating and, oh my goodness, this thing can wipe me out and it's a horrible thing and I made a stupid mistake and whatever. You don't have to get all emotional about it. You hit the close button. You take a pop of a few ticks. It's not a big deal. It happens, right? You hit the close button. Number 2, you immediately, upon noticing that very aggressively move your initial stops very close to your entry to allow them to stop out. In this case here, oops, what are we talking about? What the heck is this thing doing here? Yeah, okay, there we go. Right. Yeah. So that's the immediate action that you take. In this case, your 10-12 initial stop was sitting just under the midband. You drag it up here. Maybe you wait. You can obviously wait for this bar to close right here. And you can put it, say, a tick or two under there. Of course, you can see, obviously, when this bar formed right here, it got you out. All right, so you got a pop of 86 to 82. 4 ticks on a 1 lot's $40. 4 ticks on a 2 lot is $80. Maybe you were down here and it's an extra tick, 50 and 90 or 50 and 100 or 40 and 80. Now, let me add one final caveat on this that is important when discussing losing trades. Okay, this is extremely important. Everybody sees what to do, and almost everybody in here's typed in hit the close button. That's number one. When you see something reversing in your face, you don't feel good about it. Bars are closing down on a long trade. You're upside down real quick. Hit the close button, get out, regroup. Okay, now I want to put something in here though, and this is important psychologically for you. Okay, and this is what you got to consider when you are considering what instrument to trade. Let me put this in here. This is really important. Okay, and it plays into the psychology of taking losses, and it is as follows. You have to be comfortable taking not only losses, but taking the losses that your chosen instrument, I'll put it this way, chosen futures instrument will give you. Now, what am I talking about? What does that mean? That doesn't make any sense to me. Get comfortable with the chosen thing. What are you talking about? Is some kind of chosen, come down from the mountain and somebody said, whatever? What am I talking about there? You have to be comfortable taking the losses that your chosen instrument will give you. So are we saying with this statement that all losses on each instrument will be the same? Is it possible that some instruments will give you larger losses than others? For instance, is it possible that a high flyer and a big mover like NASDAQ that can fly, 10, 20 ticks in a heartbeat, 20 ticks down, 30 ticks up, 100 ticks up, 40 ticks back, is it quite possible that instruments like that could give you larger losses than like an ES would give you? Well, yeah, now not every trade is a winner. Yeah, not every trade is a winner, but are the losers all the same? Are the winners all the same? Is every instrument a little bit different? It is. So accepting, when I say being comfortable with the losses that your chosen instrument will give you, when you select an instrument, this is part of your risk management profile, yes? You have to go in and take some trades. You have to get a couple winners under your belt. You get a couple losers under your belt. Get a couple stop outs maybe at break even. Get a big runner, a couple of those under your belt. And you're going to get a flavor for how much this thing runs in your favor. Can you put 1 or 2 lot on? You're going to catch the runners. How much are they going to be? And so when we say that you're going to take losses on a chosen instrument, we are establishing what? I have to type something in above this that you are establishing when you say that you're going to take losses. You're establishing what? What do we call losses? What is that determining? Starts with an R. I'll give you a hint. Starts with an R. I need to fill something in here for what we are establishing when we say losses in an instrument. What are we determining when we do that? Starts with an R. Every instrument has it. If you're going to trade anything for that matter, it doesn't matter, stocks, Forex, options, whatever. Currencies, cryptocurrencies, they all have R-I-S-K. Almost all of you said it. You are establishing your risk level. I can tell you for a fact that high-flying instruments like NASDAQ futures, NQ, have a much higher level of risk. And that's why we don't have it in the room anymore. What that means is that it's quite possible that an instrument, you could take multiple losses in a row before you catch a trade to make it up. Some people like that. I have friends that trade NASDAQ. They love it. They love the volatility. But they will admit to you that they take a few pops before they catch a runner. So the risk profile is very different with something like NQ. Yes? The risk is different than crude oil than ES. You have to establish your risk. The risk is telling yourself how many dollars you stand to lose on any given trade. This is your risk. You think that's something important you might want to know about whatever you're going to trade? Of course it is. Okay, good. Now, let's move on. Let's look at some winners and losers on something else. We got about 15 minutes left. Let's squeak another instrument or two in. Go ahead and type in if you can. If we can catch one or two more instruments on here, what might you want to see? Let's look at some winners and losers on at least one or two more here before we run out of time. What other instrument might you want to see? The logic is not going to change, by the way. The fundamentals of managing losing trades you've learned right here, just to be clear. All right. The basis of what you are being taught tonight in terms of management of losers is all contained in what I've just shown you right here. This is it. This is the bulk of the potato being served up right here. The meat. This is the meat right here. So I really want everybody to embrace this. Oops, I don't know where the heck that came from. Some ESs, couple of golds, a Russell or two, couple of Russells. All right, let's see what we can work our way through here. Let me pause for a second. Stand by. Does everybody have this committed to memory? This is recorded, by the way. I've seen a few of you come in late and a few come out a little bit early. Don't worry about it. By the morning, we'll make sure everybody gets a copy of this. Okay, we'll post it to the public website on the webinar link, and we'll also get it up in the subscriber area for all you subscribers that want to see it. Stews for dinner? All right, stand by. Let's get an ES chart up here. Okay. ES is still on June. All the equities are on the June contract still. I like ES. Most days, there are days when it chops. It can get in these very sort of 10, 12, 15 tick ranges that are usually scalpable. But you got to be comfortable scalping a range. The Russell, as you know, can get a little spastic on you. Okay, let's do another exercise together. Let's see, what do we want to do here? Did you like that exercise where we looked at some winners and losers? Is that helpful? Do you want to look at ES and look at the same thing? Some winners and losers? Ones that worked out, ones that didn't? Yes or no? What do you think? I got ES teed up here, so let me know what you want to do. By the way, how would you categorize that? Okay, I see a lot of positive feedback. You definitely, okay, you want to see winners and you want to see losers sort of right next to each other so you can understand them both together. That crude oil that we showed, was that an avoidable loss or an unavoidable loss? The mid-band trade that didn't work out, the one that we showed that resulted in a loss. Would you call that an avoidable loss or an unavoidable loss? On the crude one that didn't work out, what category would that get lumped into? Now remember, let me just put this up here to remind you, and it's not good or bad. This is just the way it is, right? when we say the term avoidable loss, losing trade, we are referring to a trade that you probably should not have taken in the first place. Avoidable means you could have avoided that loss because you got, like I said, you got in circumstances, got you in too early, too late, whatever the reasoning behind it was, but it was avoidable. You could have not taken it, and so you could have avoided it. That's an avoidable loss, right? These are trades you probably should not have taken. And you got to look at that. You got to be honest with yourself in this business, right? You can't just get to the end of the day and say, well, I feel pretty good about how things went today. You got to go back and look at how you really did. Did you get into those trades where you should have? Were you late? Why did you get that stop out? Did you get in too early? Was that a trade you shouldn't have taken? Okay, so avoidable losses trades that you probably should not have taken. Thereby, it is avoidable. Right? Avoidable. You could have avoided it by not taking it. That's essentially what that's saying, right? An unavoidable loss would be unavoidable loss is a trade where you got into a legitimate trade. So that crude oil example was, in my opinion, an unavoidable loss because it was a legitimate trade set up at the mid-band. Yes? It didn't work out. You stopped out, right? But it was still, if you had the chance to take it again, that's what you got to kind of ask yourself, right? If I had the chance to take this trade again, would I still have taken it? And the answer in the case of crude was yes. It was a mid-band trade, right? So finishing out this statement, an unavoidable loss is an example of a trade that you should have taken and did take. It was a legitimate trade, yes, and it just didn't work out for whatever reason. You know, there was no follow through. The market reversed. There was a tweet that came in from nowhere, some unavoidable news event that was not anticipated, and so we see that what we have to do in order to survive in the long term with our trading account is we need to keep those losses to a minimum. That's the key, right? So let me just go ahead and put that in here, and then you got to always sort of keep this in the back of your mind, right? Is that we always, losses are okay. Look, I used to be a perfectionist, and I used to drive myself nuts with this. Okay, I couldn't stand losses. I would kick myself for the longest time. I get so upset, you know. In my younger days, right? You might know this. You're swearing, you're slamming stuff, and you're all angry and upset, throwing things, and all manner of physical reaction to it. And you have to calm yourself down, start looking, figure out what to do to get back in the market. And next thing you know, a trade came and you missed it, and you could have made all the money back with that loss. Hey, look, I've been there. So many times I failed to even want to talk about it anymore. Right? So anyway, what's the lesson from that? You got to get comfortable with losses, because they're going to happen. And you got to keep them to a minimum. That's the key, right? You got to just, when you see it, you get popped for whatever the reason is, avoidable, unavoidable, doesn't matter. You get out quick, and you keep them as small as possible. And some of you typed this in when we first had the questions almost an hour ago, and we kicked this thing off, and we started saying, well, what do you do to, some of you typed in, well, you know, you don't ever get into a hope trade. A hope trade is where it reverses on you. You don't pull the trigger to get out, and you get into this horrible spiral of pulling the stop away, thinking it's going to reverse in your favor. That's called a hope trade. Please, pinky swear 1,000,000 times. If that's you, you got to stop doing that. Rarely does a hope trade turn around in your favor. It normally contributes to making huge losses that you wind up regretting. Yeah, so don't do that. Okay, so here we go into a downtrend. Let's look at some trades that worked out on ES, and maybe a few that didn't. Okay, all right. So where are we here? Let's see. Let's get oriented. Here is midnight Pacific time right here. This is the tail end of the. Here's the close on what's today? Thursday. So Wednesday close was over here. Going into the Asian trading session overnight. Most of you know that, right? Big banks in Hong Kong, throughout Asia, trade futures 24/5. This is the Asian session right here. So we were in a very protracted downtrending move for the Asian session, right? Where was the trade? Was there a legitimate mid-band trade here in the Asian session? Yeah, see it? See it right here? Did she come up and kiss the mid-band at 49 1/4 and roll over quite nicely for a beautiful short? No heat, right? Did you get the scalp off? Yeah, I went down, checked the bottom, and broke it. So this was a beautiful example of a mid-band kiss and roll short that worked out quite nicely. No heat, never came back on you, never broke up above your stop, right? Of course, you would have to be a night owl or over in Asia trading the Asian session or however you like to trade that. Now we go into the European session after midnight Pacific right here. And you can see very clearly that the E-mini S&P futures, ES contract, was still very much in a protracted sell-off or a downtrend. Here's another retracement back to the mid-band right here. Very clearly at 41, another kiss and roll short. Textbook. The only more textbook it could be if it was just slightly higher and physically sitting on the mid-band itself, but it's within the band of it, yes. Pulls back a little bit. I don't know. If you were filled on this bar here, you might have felt a couple of ticks of heat. Not much for a couple of bars. But your initial stop, it never even came close to the mid-band up here. In cases like this, let's talk about that for a second, okay? Let me before we go into looking at other trades on ES, let's blow this up quite a bit and have a little more discussion in regards to this. Let me get this out of the way and talk about it. Now, depending on how you drew this box, when and where exactly you drew it, and let me be clear what I'm talking about. If you had used an extremely tight region box just under the mid-band right here, it's quite possible you were filled short on the close of this bar right here. Now, as I said earlier, could you put limit orders in here? Could you be shorting the mid-band as it's hitting it? Yes. Is that better fills than a box with a close? Yes. Is there different risk associated with it? Yes, of course there is, because it's quite possible you could get a bar or two in your favor and it could blast right through it and stop you out. However, if you take that approach, and I've shown this in other webinars, I've shown this, okay? If you put limit orders here and you get filled at a higher level, obviously your scalp on ES is going to come off a lot faster because you're filled here. You're not waiting for a bar close. You get filled 3, 4, 5 ticks higher, thereby putting your scalp trade closer. Let's talk about this. Let's blow up these two trades and have a very, very quick discussion about this. Limit orders at or close to the mid-band might be filled as high as right here. Short. In the case of a region box drawn just under the band, as I show it right here with this rectangle, you would be filled short on the close of this bar right here. And I'll show you those different levels in a second and what they mean to you. If you had drawn a much larger box that engulfed this candle right here, that might look something more like this, in this case here, you were not actually filled until the close of this bar. Right here. Now, let's talk about the difference in how that trade looks to you as a trader. If you decide to use limit orders up at or around the mid-band for your entries in a big trend like this, you have to make sure that you have a good solid trend in place to do that. Okay, if you're range bound, chopping around, and the direction's not really clear, okay, that you don't really want to do that because the likelihood of stop out can be high. Notwithstanding your entry, whether it was here, here, or here, you always want to pretty much keep a tight stop above the midband right here. So let's talk about the three different entries and what they mean to you, and then we'll look at couple that didn't work out. In the case of just under the midband, you could have been filled as short as high as 48 3/4, 49. So if you go with a 4 or 5 tick stop, you only have to get to what? 48, 47 1/4. In fact, this trader's scalp trade is taken off right here. When this trader is getting in, this trader is already pulling a scalp off. In the case of secondary entry right here on the close of this bar with the tighter box and the close below, this trader is filled at 47.50. If you want a 4-tick stop, you got to go to 46.50, or a 5-tick target, that would be 46 1/4. This secondary entry, let's call this entry 1, let's call this entry 2, and let's call this entry 3. A 5-tick target would take you out here. So in the case of the trade number 1 and 2, both traders on this move right here had taken their scalps out. Now on this little pullback here, this little ABC pattern, oh, Jiminy Christmas, what just happened? Oh, no. Oh, Lordy Lord, what happened to me here? Stand by. My chart freaked out. Okay, I'm getting back. Hold on. Don't panic. Okay. All right. Where are we? Okay, here we are. I got it back. Now, in the case of trade number 1 and 2, of course, you see they got their scalps off. In the case of trade number 3, with the larger box filled on the close of this bar, did you feel some heat? Did trade entry number 3 feel some heat with this pullback here? Yes. Did those, because you're filled here, you're short from 46.50, 46 1/4, and it came all the way back to 47.50. You felt 4 ticks of heat, and maybe you got a scalp off here. Ooh, it's close. 4 ticks, 5 ticks, you would not have got it. And did you feel more heat over here? Trader number 3. Yes, you did. Would trader 1 and trader 2 have felt any heat on this price action here? Probably not. Not much at all. Yeah, you would have got your scalp off, and you would have seen your P&L go to 0 here on trade number 2. Trade number 1 was always in the money. Pop quiz to make sure everybody's still awake before we run out of time. Which one of these trades had the lowest risk associated with the entry? Trade entry 1, type in a letter, and I'll give you a number, and I'll give you 5 seconds. The lowest amount of risk would be associated with entry 1, here, 2, here, 3, here. The least amount of risk, if you were to associate it with one of the 3 trades, would be which one of the 3? You got 3 seconds left. Just type in a letter. Trade entry 1, trade entry 2, trade entry 3. 2 seconds. Just pick a letter. Boop. 1, 2, boop, 3. 1 second. Cast your vote. Time's up. 1. Well, the reason for 1 is we can see that the associated initial trail stop is sitting, of course, right here. So in the case of 1, from an entry of 48 3/4, 49-ish, your stop is here at 49 3/4. You could be risking as little as 3 or 4 ticks, trade entry 1. Contrast that with entry number 2 at 47.50. With the same associated stop here at 49, you're risking 9 ticks. And of course, you can see down here, 3 is the most risk at 46.50 all the way up here to 49. That's as much as 10 ticks. Yeah, trade entry 1, you didn't feel any heat on these little ABC retracements off to that when it punched through this entry number 3, because your entry short was up here, so you never felt any heat, and you got your scalp off real quick. You know, if you can train yourself on well-behaved instruments like ES, especially when it's in those big moves like that, and you get those beautiful retraces, you know, you can take those entries close to the midband with tight stops. All right, let's look at an example on ES before that didn't work out. And I was going to do another exercise on one that did, but let's not waste that. Okay, let me do another pop quiz before we wrap and make sure everybody's on board with. I'm going to show a couple more trades here, and I'm going to ask questions and look for responses. Almost all you got that last one right. 1. Yeah, that's correct. There was a few that said 2. Obviously, you can see now you're looking back, 1 was the correct answer. I'm going to do 2 more questions for you, and then we're going to wrap on this session. The region box that I have drawn here, engulfing these yellow candles on ES, was it ever filled short, yes or no? 5 seconds on the clock. Just a Y or an N. Just look at the region box, and it's very simple. Just one letter. Y, boop, for yes, and boop, for no. 4 seconds. Was this box on ES ever filled short? 3 seconds. Cast your vote, team. This is the last of the couple questions we're going to ask. 1 second. All right, time is up. No. In the case of when we had drawn this box, and of course this was 3 or 4 hours into the European trade session, when we drew it, the background was red, and it was exhibiting behavior similar to this retrace and similar to the retrace we had earlier where we got short. And so you were looking for short, engulfing, in all likelihood, at this time of the morning, short only. So there needed to be, to enter here, a close below the region box itself to get short. And in any case, did a bar close below it? No. This bar, although it was close, never closed below it. The answer was no. You were never filled short. Now, last quiz question before we wrap. Are you ready? I'm going to advance ES. And when you think you see a region box mid-band trade, well, yeah, if you had drawn the box tighter, Michael, yes, you would have. Here, let me show that real quick. His question was, if you had a tighter box, would you have been filled? And the answer is yes. Let me show how that could have been. Would it have been possible that the box was actually drawn more like this, engulfing the wicks of the bottoms of those candles? In the case of that example, you would have been filled short on the close of that bar right there. Now, in Michael W.'s example with the tighter box, when you were filled right here, short, and you had the wick of this candle going down in your favor, then closing back up, and you had a second bar closing back up right here, and then a third bar closing up right here, what should you have done? Remember, you tight box traders, you're filled short here. It looks like it's going to start heading down, but all of a sudden this candle wicks up. You get this big hanging Chad Doji kind of thing right here. And then all of a sudden all these bars start closing up against you on your short. What the heck? What about this follow through down to the bottom? Not happening. Uh-oh, what are we going to do? Hit the close button. Yeah, it's like you're in Florida with a hanging Chad on the voting paper, the ballots or whatever. Yeah, you're right. That's a good call, Chris. Good catch. Make note of the fact that a green stealth had shown up, and it was very clear at this point. Maybe not on this hanging Chad Doji candle. Certainly by that candle right there. And if you hadn't hit the close by there, very definitely when it's up here taking that out, you wanted to very definitely be out of this trade. Close button, Aru, good for you. Now I'm going to advance it on 4:26 a.m. And when you think you see a mid-band trade entry, you type in the letters MB, signifying mid-band. You don't have to say long or short. Final exercise. Here we go. Yeah, 4:26 a.m. Pacific. You're well into the European trading session on ES. Here we go. Okay, there's 435. 440. I did that pretty fast. Let me back up. 426, 428, 431, 435, 439 a.m., 442, 450, 451. So you'd have to be an early bird here. You're going to see the market doesn't open in the U.S. on the equities for another hour and a half. You're 451, 457, 5 o'clock, 504, 509, 517. Remember what the exercise is. Mid-band trades, yes. Okay. 520, 526. So just to explain here, we've covered over an hour, and I've done it in the span of like 2 minutes. So I'm going like 500 times how fast these bars would have really actually painted in real time. So, don't worry if you're having trouble sort of keeping up with it, because I'm moving very rapidly to explain what we're talking about here. The dip between this bar here at 516, that bar didn't until almost 518. 2 minutes. Each of these bars is taking like a couple to 3 minutes to form. So between here, at 505 and here is like 20 minutes. All right, let's continue on. 530, 536, 540. All right, time's up. Now, let's look at it now that you have the benefit of hindsight of seeing all the bars together. Some of you had typed in MB signifying a mid-band trade when these bars formed right here. Was that correct? Was that a correct? Are those two bars by definition meet the criteria for a mid-band trade, yes or no? Now looking back on it in a static manner, it's always harder to see it when it's in real time coming flying at you. Bars going up, bars going down. What the heck is this thing doing? But now you have the benefit of just sitting and staring at it. Yes, our definition of mid-band trade, in this case you would have been long, is in the band above, below, and right on the mid-band itself. And this does meet that criteria. That was legitimate long. And in all likelihood, you probably got a scalp off the close of this bar right here. Good. Now, some of you started typing in MB when these bars formed right here. Was that correct? What do you think? Well, I didn't say it was a 10-tick target on ES. What was the scalp target on ES? Was it 10? Who's keeping up? Who's keeping score? Was 10 ticks the scalp target on ES or crude oil? What was the scalp target on ES that we showed like 3 trades ago? Anybody remember? Was it 10? Anybody awake out there? I don't remember a 10 on ES. I remember a 10 on crude. Yeah, I'll give you that one. It was 4 to 5 ticks. Good. If you're going to trade ES, look, in choppy, low volatility times, if you can scalp out 4 ticks and then get your stop up tight, that's what you're looking for on ES, okay? You can get big moves like 20, 30 plus ticks, but they're pretty rare on ES. They don't happen a lot. And so you got to take your money quickly. And so you're looking really for 4 or 5 ticks on your scalp. So let's see. Did this get it? Here, let's not guess. Let's get a real answer here. Don't leave any ambiguity on the table there, Mr. Charles. Filled 28.33 even. Close of the bar. And 4 ticks would be 34. There's scalp 4 ticks. 34 and a quarter. Right there, and actually going all the way to 34 3/4, so that is almost 8 ticks. Yeah. Now, depending on how you drew this box, if you had drawn a box that ended here, were you ever filled long? Was this box ever filled long? No. If, however, you continued the box onward, as shown here, all the way over into here, would you have been filled long? Yeah. Well, depending on when you drew it, probably on the close of that bar, quite possibly on the close of one of these 2 bars, depending on when you drew it, and very definitely on this bar over here. Now, we're talking about between here at 5:23 and here at 5:36, you're looking at about 10, 12, 13 minutes of chopping around and bouncing, chopping around and bouncing, chopping around and bouncing. Here you were filled at 32.50. Here you filled at 32 3/4. Here you're filled at 32.50. And you went all the way down here to check the bottom of the box at 30.50. So when this wicks of candles were checking the bottom of the box, you were actually upside down on one of these 3 trade entries by 8 ticks right here. Should you have closed this trade, yes or no? With the 8-tick pullback to the bottom of the box. This is the final question, and then we're going to wrap. You drew the extended box here, and you let that puppy run all the way out from, 5:04 till, I don't know, 5:30-ish. And sure enough, you get filled. Whatever. And it goes back in the box, but it holds the bottom of it right here, just under the midband. Should you have hit the panic button to get out of this trade, given this condition, yes or no? What say you, team? It depends on the condition, Brian. As I mentioned earlier, there's not one pat answer for that. Don't you follow the bars down to get a tighter box? It really depends on the condition. And they're all. I mean, you really have to kind of look at what is it trending? Is it a strong trend? Is it respecting the midband? How close is it coming to the midband? Those are all factors to take into account. But generally speaking, the tighter the box, the better. Yeah. And if you can get limit orders close to the midband itself, that's even better with a tight stop, as little as 2 or 3 or 4 ticks. Are you going to get popped on a few of those? Yeah. Are you going to get your scalp off a lot quicker? Yes. Now, it's possible that you can get in and out of this, but what I'm going to tell you is with an instrument like ES, where you don't get a lot of this high flying around bars, whipping down into here, and all of a sudden flying up 30 ticks, and it tends to respect these support and resistance levels really nicely like that. ES is one of those instruments where it comes down and holds a support level. You can hold through this, all right? Now, if it went down and took this out, yeah, you should probably dump the trade, no question about it. If it flipped and blew through here, yeah, you'd want to be out of it. This has happened several times even this week. There's been lots of times right at the open of the market where ES will chop in the morning in maybe a 15-tick range and come down and sit on a support level like that all morning long. Can you put limit buy orders down in here and get in at a better price? Of course you can. You have to wait for a close up? No. Can you be buying right here? Of course you can. Yes. Could you get in here with a limit order and put your stop super tight here? Of course you can. I don't. Depending on the market condition, you can use that rule that if it closes back in the box, you can get out. You can use that rule. You can get in, and it closes back in, you get out. You can get in, you close back out. In a lot of instruments, if you're getting in and out like that, and they're not respecting support, you're going to get chopped up. In the case of ES, you can get away with it holding support areas because it tends to respect those so well. Tell you what, tomorrow morning what we'll do is I'm sure this condition is going to set up again tomorrow, somewhere in the 2 hours that we're trading in there. And if and when it does, we'll call it out in real time, okay? 6:20. Oh, geez.